Good evening and welcome. This is a continuation of our video series, The Basics of U.S. Personal Income Tax. We are in Lesson 5 of the video series. So we're talking about income, specifically interest, dividends, and other income. And the key content for this evening is taxable interest, tax-exempt interest. We're going to touch on U.S. savings bonds. We're going to go into just some depth regarding dividends. We're also going to cover taxable state and local income tax refunds. So we're focusing tonight with Lesson 5 on unearned income. That would be taxable interest, tax-exempt interest, dividends, capital gain distributions, non-taxable distributions, as well as unemployment compensation. When we are reporting interest, income, and dividends, there's a few things that we need to remember. Interest, incomes, and dividends are the most common types of unearned income. Most types of interest and dividends are taxable. All interest and dividends, whether taxable or untaxable, must be reported on your tax return. Generally speaking, interest over $10, you will receive a Form 1099 INT. Dividends over $10 would be reported to you on a 1099 DIV. DIV for dividend, INT for interest. There are substitute forms 1099 INT and 1099 DIV that may also be used. Interest and dividends over $1,500 would be reported on a Schedule B of the 1040. This is what a 1099 INT looks like. You have information here regarding who was the source of the money. You would also see the recipient's identification number here. This would typically be your Social Security number. The amount of interest would be in box 1. If there's any early withdrawal penalty, you'd see it here in box 2. If the interest was related to U.S. savings bonds and treasury obligations, you would see it here in box 3. In the event that there was federal income tax withheld, that would be reflected in box 4. If there were any investment expenses that are allocated to this income, that would appear here in box 5. In the event that there's foreign taxes that were paid in order to generate this interest income, you would see that in box 6, and you would list the foreign country in box 7. If there is tax-exempt interest, it's going to appear in box 8. And if there's any specified private activity bond interest, it would be in 9. Any market discount, bond premium, tax-exempt bond, QSIP numbers, and then you would see your state and your state identification number and any state withheld if you had withholdings down here in 13, 14, and 15. So those are the boxes, and that's a brief description of what you would see for a 1099 INT. Here's a 1099 DIV. Again, you've got room here for the payer. Same, you're going to see the Social Security number. The boxes associated with dividends and distributions would be 1A for ordinary dividends, 1B for qualified dividends, 2A for capital gains distributions, 2B for unrecaptured Section 1250 gain, 2C would be Section 1202 gain, 2D would be anything related to collectibles, which would see a 28% gain. 3 would be non-dividend distributions. 4, again, we have our withholdings. 5 would be the investment expenses. 6, foreign taxes paid. 7, the country. 8, any cash liquidation distributions. 9 would be non-cash liquidation distributions. 10, exempt interest dividends. And 11, specified privately active bond interest dividends. Again, 12, 13, and 14 provide a room for state identification number, and the state taxes withheld. So these two forms are laid out as traditional DIV forms. There is also substitute forms. This is what a substitute form would look like. So here you have both the 1099 DIV as well as the 1099 interest on a combined form. There is not a standardization regarding what order they would be placed in. You can see that underneath each of the main titles, you will have the identification of the box that the amount is related to. So we see here that box 1A has the ordinary dividends of $425, and box 1B is showing 215 of those are qualified distributions. In addition, that you have your capital gain distribution showing is box 2A. Those would have been the only boxes completed for the 1099 DIV. Up here you'll see the payer identification number, the recipient's ID, as well as the information about both who the interest and dividends are being paid by, as well as who they're being paid to. The 1099 INT form is just showing interest income in box 1. So this particular substitute form does have these laid out pretty clearly. In some cases, you might only see the lines that have a dollar amount. So typically it would say box 1A and the dollar amount if it's going to be abbreviated at that level. Taxable interest is reported on line 8A of the 1040. So in this example, Sarah earned $49 in interest on money in her bank savings account. She would report the $49 as interest income even though she did not withdraw it from the bank. Taxable interest is typically from bank accounts or from loans that you make to others, and it can be from other sources. Oftentimes, if you have funds that are in a taxable account, you will see any interest that's being related to you on a 1099 INT. In the event that you are receiving a refund outside of the normal tax time period, it will typically pay interest, and you will receive a 1099 INT either from the IRS or from the state in the event that you received that tax refund and there was interest associated with it. The next year you would need to report the interest and it would be taxable. This is what a Schedule B looks like. The Schedule B would be completed with the information related to the interest in the event that the interest is over $1,500, or in the event that the dividends are over $1,500, you would report that in Part 2. So here we have Luke received $1,500 in interest from BB&T Bank this year. He will report the $1,500 directly on line 8A of the 1040. If his interest income from BB&T was $1,501, then he would also need to report it on Part 1 of the Schedule B, as is shown in the example below. Taxable interest. These things can be considered taxable interest. Interest on certificates of deposit. Not really an issue right now. Most certificates of deposit are not really paying interest. Deposits or shares of accounts, U.S. obligations, U.S. savings bonds, installment sale payments, life insurance proceeds, tax refunds, gifts for opening accounts. So that would be like if your bank were to pay you $25 for opening your account, that $25 is considered interest. The life insurance proceeds, in many instances, whole life policies begin paying interest on the amount that is the cash value amount, and that interest may actually be used to pay the premiums. You will still receive a 1099 INT reflecting the amount of interest that was earned, which it would be taxable in that year, even if it was being used to pay for premium payments for those accounts going forward. So that's some information on taxable interest. U.S. savings bonds. There are 3 series that we are working with right now, and those would be the HH bonds, the EE bonds, and the I bonds. Certificates of deposit. If you buy CDs with a maturity date that is more than 1 year, you should include part of the interest as income each year, and this would be true with the savings bonds as well. If there's an early withdrawal penalty for withdrawing the money, this amount can also be would be reflected. The early withdrawal penalty would be reported in box 2 of the 1099, and we would report it on line 30 of the Form 1040. So we do not receive tax on the amount that was penalized. In this case, Tom has a CD. It matures in January 2015. He paid $75 in interest in 2014. Does Tom include the $75 of interest as income on his 2014 return? Yes or no? What do you think? Yes. Other types of insurance, it would be the life insurance proceeds. We discussed that. The tax refunds, we discussed that. And gifts opening an account, we discussed that as well. Tax-exempt interest. Tax-exempt interest would come in the form of any type of interest that's being paid on obligations to U.S. possessions, such as Puerto Rico, District of Columbia, or any state or political subdivisions, so counties, any type of bonds that are available that are going to be paying you interest, that would be tax-exempt interest, and it would be reported on line 8B. Now we're going to switch to dividends. Dividends include distributions of money, stock, and other property paid to you by a corporation. You would report dividends over $1,500 on Part 2 of Schedule B. Dividends may also come from a partnership, an estate, a trust, or an S Corp, and in those cases, it would be reported to you on a Form K-1. Major types of dividends are ordinary dividends, capital gain distributions, non-dividend distributions, and something that we just call collectively other distributions. Ordinary dividends are taxable income and are paid out of the earnings and profits of a corporation. They are not capital gains. This is what your Part B of the schedule, Part 2 of Schedule B looks like, and that's where you would report your dividend information with more detail. So you would actually put the name of the payer as well as the amount. If you had several payers, each payer would be listed here with the corresponding amount. The threshold for $1,500 would be the sum of all of the dividends. It is not just an individual dividend. In this case, 1646 coincidentally is both over $1,500 and the only dividend that was being reported on this return. Qualified dividends are the ordinary dividends that receive favorable tax rates. So you would show your qualified dividends separately and they would go in box 1B. And how you would know that you have qualified dividends is they would actually be reported in box 1B on the 1099 DIV. Capital gains distributions. You receive capital gains distributions from mutual funds and real estate investment trusts. In this case, they pass the capital gains on to their investors in the form of capital gain distributions. Capital gain distributions occur when a mutual fund sells assets for more than their cost and they realize a capital gain. Capital gain distributions are reported on box 2A of the Form 1099 DIV. Capital gain distributions are reported directly on line 13 of the Form 1040 if there is not a Schedule D that is required for the rest of the return. Corey does not have to file a Schedule D. He received capital gain distribution of $450 from Arthur Anderson Investments and $245 from Facebook in 2014. So you're going to see here on line 13, he's checked the box that he is not required to file a Schedule D, and he's put the entire $695 in line 13, and there is no additional detail that would be used on the return. Non-dividend distributions. A return of capital would be reported to you on box 3. Return of capital is included and taxed as capital gain once your basis has been reduced to 0. So in this instance, for capital gain, return of capital dividends, you have made a cash investment into whatever it is that is paying out these dividends, and you are entitled to recover your basis or your initial investment before you actually pay taxes. So let's look at an example. James purchased stock in 2000 for $5,000. He received a return of capital gain of $1,500 on the stock in 2003. In 2014, he received a return of capital gains of $4,500. So what would be the taxable amount? He had an initial investment of $5,000. $1,500 was paid back in 2003. So the remaining $3,500 would be paid back out of the $4,500, and the taxable amount would be C, $1,000. Another distribution that we're going to cover, because it's kind of one of those bizarre tax topics, is the Alaska Permanent Fund Dividends. This is basically like a reverse income tax where the citizens of Alaska are actually paid by the state a stipend amount or a dividend amount relevant to the oil pipeline and other natural resources in Alaska. So Alaska happens to be one of the only states that provides their constituency with actual cash for living there. Taxable state and local income tax refunds. It would not be taxable if you claimed the standard deduction in the year in which you received the refund, or if you elected to deduct state and local general sales tax on your Schedule A. So if you did not itemize your taxes, itemize your deductions, if you did not use an itemization for your deductions, then your refund would not be taxable. Your state and local refund would not be taxable. Part of it may be taxable, or possibly all of it, if you itemize the deductions in the year in which you received the refund. If you claimed state and local income taxes as an itemized deduction. So we're going to look at an example here. Natalie's 42. She received a Form 1099-G, and her state refund is $325. So we need to now look back on her 2013 return. We see that her total itemized deductions was $7,200, and her filing status was single. So we're going to fill the worksheet out below. But the key thing here is that Natalie will be taxed on the $325, and that $325 will be reported on line 10 of the 1040. So let's look at how the worksheet lays out. So the first thing that we put in is the amount that she received, which is $325. Then we're going to put in the total itemized deductions from her 2013 return, which is $7,200. The next thing we're going to do is look at what a standard deduction would be. The standard deduction would have been $6,100. So because the $6,100 is greater than the $325, we are going to be taxing the full $325. If the difference between the itemized deducted amount and the standard deducted amount is very small, someone barely qualified to itemize, let's say it was $6,200 instead of $7,200, well, then this is going to be $100, and then only $225 would be taxable. So that's how that works. So just to review, you would report interest and or dividend income that's over $1,500 on a Schedule B. You report on line 19 any unemployment compensation that you receive. You would report early withdrawal penalties for CDs on line 30. You're going to report your capital gain distributions on line 13 if you're not required to file Schedule D. State and local tax refunds that are included is taxable income if you itemize your deductions for the refund year and you received a tax benefit by including your state and local taxes in the itemization. So if you included the amount that you paid in for local taxes in your itemization, that's one of the things that they look at to determine whether or not your state or local refund will be taxable. So the information that was used in this particular course came from publication 17, and I believe that this is chapters 7 and 8 of publication 17. If you have any questions, please feel free to refer to the publication information or send us an email through our website, and good luck. Thank you so much for watching.